Hi everyone, welcome back to the channel. Today we are diving into a fascinating economic comparison between two global giants, India and China. On one hand, we have China, the world's second largest economy with GDP of $18 trillion. On the other hand, we have India, a rising star with a GDP of $4 trillion. Despite the disparity, these two nations are often compared for their growth trajectories, governance styles, and economic ambitions. In this video, we'll break it down into 5 key areas: industrialization, trade, demographics, governance, and innovation. So stick around till the end to hear how these strategies could shape the future of global economy. Let's start with industrialization, a cornerstone of economic growth. China's transformation began with Deng Xiaoping's 1978 reforms, which opened up economy to global markets. Creation of special economic zones, SEZs, like Shenzhen attracted massive foreign investments with tax breaks, minimal regulation and access to low-cost, highly skilled workforce. China quickly became the world's factory. China invested heavily in infrastructure, highway, ports, and world's largest high-speed rail network, creating an efficient ecosystem for manufacturing. Its focus on mass production and exports turned industries like electronic, steel, and textile into global leaders. Today, China accounts for over 28% of the global manufacturing output, making it a powerhouse in industrial production. But this model isn't without challenges. Rising labor costs, environmental concerns, and overcapacity in key sectors are now testing its resilience. India's story is different. After liberalizing its economy in 1991, India leaned more towards services, with IT and software becoming major growth drivers. Manufacturing, however, lagged behind. Fast forward to 2014, and the Make in India initiative emerged. Its goal is to boost manufacturing share of GDP from 15% to 25%. Companies like Apple and Samsung have since set up production in India, signaling a shift in global supply chains. India's production-linked incentive (PLI) scheme are now attracting investments in sectors like semiconductors and EVs. However, challenges like bureaucratic delays, infrastructure gap, and rigid labor law persist. China's industrial model is built for scale, speed, and dominance, while India is focused on sustainability and long-term growth. The big question is, can India replicate China's success story while preserving its democratic value and diverse economy? Trade is the lifeblood of both of these economies, but their approaches couldn't be more different. China is the world's largest exporter, with trade contributing over 35% to its GDP. Initiatives like the Belt and Road Initiative (BRI) have cemented its role in global supply chain. However, geopolitical tensions with the US and European Union are creating headwinds. India's trade to GDP is smaller at around 20%, but it's growing steadily. Instead of scale, India focuses on diversification, signing free trade agreements with countries like Australia and the UAE. By staying out of RCEP, India prioritized protecting domestic industries over short-term gains. While China leverages scale, India's strategy of carefully diversifying market could help it weather geopolitical and economic shocks better in the long term. China's one-child policy has created a demographic time bomb. With a shrinking workforce and an aging population projected to be over 30% of seniors by 2040, China faces mounting economic pressures. India, on the other hand, is experiencing a demographic dividend. Over 65% of its population is under the age of 35, providing a massive workforce for decades to come. But this potential depends on creating jobs and improving skill levels. While China races against time to address its aging population, India must act quickly to turn its demographic edge into real economic growth. Governance plays a huge role in shaping economic outcomes. China's one-party system allows for rapid decision-making. Massive projects like its $1 trillion BRI are executed swiftly, but this speed sometimes comes at the cost of public debt and innovation in private sector. India's democratic system ensures broader stakeholder input, but often slows policy execution. Despite this, reforms like GST and infrastructure initiatives like Bharatmala are setting the stage for long-term progress. China's model delivers results quickly, while India's governance prioritizes inclusivity. Both approaches have their strengths and trade-offs. Innovation is key engine of modern economics, and here's how these two nations stack up. China invests 2.4% of its GDP in R&D, leading in areas like AI, 5G, and electric vehicles. Companies like Huawei and BYD showcase their tech prowess. India, while spending less on R&D, just 0.7% of GDP, shines in software and digital services. Fintech innovations like UPI has changed the payment mechanism, making India a leader in digital transformation. China excels in hardware innovation while India dominates services and software. Together, they represent the future of global technology. China's centralized model has achieved unprecedented scale, but challenges like debt and demographics loom large. Meanwhile, India's democratic, reform-driven growth offers promising but slower path. As these giants evolve, their strategies will shape not just their future, but the global economy. So what do you think? Will India's inclusive approach outpace China's centralized model in the long run? Let us know your thoughts in comments below. And don't forget to like, subscribe, and hit the bell icon for more global economic insights. Thanks for watching.